Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Coinbase. We'll discuss should we pass or should we play? I think we. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Okay, we're going to look at Coinbase this week overall because they were actually made a big splash as far as crypto is concerned at the big game. So there was a lot of interest in crypto stocks in general. One of the companies that benefits from crypto trading is Coinbase. So we're going to look at that specifically this week. Also, our chief investment analyst, Lindsay Bell, came out and wrote a little piece on Coinbase, and I'm going to ask our producer to actually put that in the chat box right now. That kind of talks a little bit about a lot of the advertisement that went into crypto this week at the big game overall. So before we get too far, though, I want to start by looking at my VIX watch list. In general, we see that the markets are up a little bit after a big weekend. I got a little bit of a cold, so I'm going to persevere and try to get through this. But the S&P 500 index is up 60 or about 1.3%. So a solid move in the SPX. We still got the VIX up around the 26 level. Now, going back a couple of weeks, I kind of talked about the fact that I was surprised that the VIX was trending down towards the 20% level. And it's mainly because of what's happening in the interest rate market overall. And so my new favorite chart to look at is the TNX, which tracks the 10-year bond, and it tracks the yields in the 10-year bond. If you want to know what the yield is, you just move the decimal 1 point. So we're up over 2% on the 10-year, and the yields are not really looking like they are going south anytime soon. I think the path of least resistance is to the upside at this point in time, but it was big to break through that 2% level. So I'm going to highlight this over here on the right-hand side of your screen. We're going to look at the breakout that we had from the 2% level. You had to go all the way back, and I kind of highlighted this last week too. You had to go all the way back to the big downturn, which was August of 2019. We bumped up against that level quite a bit. Come back over here, see that we have broken through that level. Come on, work with me. There we go. And I'll zoom in a little bit on this now too. So we're still hanging around that level. Can't quite decide if this is where the interest rates need to be, but we came down, we broke through, broke below, broke above, and now today looks like we might have a solid move to that upside above that 2% level. So I don't know where the next stopping point could be in the marketplace. Not surprised that that goes along with the VIX trading right around 26%. Don't know where the actual volatility is, but I think there's a little bit of angst in the marketplace. After the inflation numbers that we received last week, the marketplace is a little bit nervous about where we're going. I think it's great on a Tuesday after the big game that we're seeing a big up move in the marketplace overall. So I appreciate that fact that we're having a solid move to the upside while we still got the VIX trading right around 26%. So Coinbase, as I mentioned, that was the highlight of our weekly email that we send out here at Ally Invest, talking about the big game and what was going on in crypto. So we're going to look at Coinbase today, and this is a great stock to talk about using options to help manage your risk. There's a lot of volatility in it. Coinbase is an exchange that trades a lot of things, but the bulk of their business is making a solid, more secure than most, I should say, place to trade these cryptocurrencies. So they have real numbers. They haven't been public that long overall, but it's an interesting way to play in the crypto space without chasing crypto, if you will. But Coinbase overall has a tendency to move as crypto does. If the cryptocurrencies are doing well, Coinbase usually will do well along hand in hand with them. It's a usual. It's never ever a guarantee that it's going to go that route. But one thing that's very odd about Coinbase is if the cryptos are down, Coinbase, being an exchange, is still going to do well. If there's a lot of volume that's created from a down move in a lot of the cryptocurrencies, Coinbase actually benefits from that. So the fact that cryptos goes down and Coinbase goes down doesn't necessarily make a lot of sense overall because of that fact. So let's go and look at the chart on Coinbase. All right. So this company has not been public that long. This was the first day, a lot of volatility when it first came public, and it really has struggled since then. We did have a move almost back to where it was on its big day, on the IPO day. And as we come on down, we see the move. This little line that I had drawn was a line in the sand for a while. It broke to the downside with inflationary fears. Who knows exactly why cryptos do what they do overall, but the company did move down, and we did have a nice break to the upside. We're bumping up against that once again. So this chart isn't the most exciting chart overall. We're at a precipice right here. Can we break above, right? So far, this is the 20-day moving average and move towards the 50-day moving average. So that's kind of what we're looking at. Obviously, talked a lot about what has happened this weekend with the big game and all of the advertisement and all the money that has been spent in this space just to make people aware of it. And so we're going to look at a trade in it. So we're going to basically go with the stock that is being talked about the most, or I should say, I guess it's a sector. I don't know what else I would call the space, the cryptocurrency space. And one thing that you can do within the stock market, they do have ETFs that actually track these underlyings, but we've talked about Coinbase before on the stock play of the day. And I still find it to be it's something that you can actually put a valuation on based off of the amount of revenue that they're bringing in, and also benefit from the fact that it is the new space. It is the new up and coming currency that everybody seems to be talking about at this point in time. So how would I trade this? We're going to do a short-term trade, and we're going to manage our risk. We have a lot of volatility in this underlying stock. So if I run to the options playbook, the strategy that we're going to look at here is a long call spread. And I want to say, before I get into the actual strategy, please put your questions in the chat box. This is an interactive show, and we love to get as many questions as we can in the chat box. I will try to address them at the very end of the show. So how do I manage my risk using a long spread as opposed to maybe buying an option outright as far as Coinbase is concerned? When we have higher volatile stocks, I like to go on out and buy one option contract, which is going to battle with things like time decay or any decreases in implied volatility. And at the same time, sell an option contract, which benefits from time decay and benefits from a decrease in implied volatility overall. So the long option contract wants implied volatilities to go up and time decay not to happen, which it's always going to happen, right? Time is going to decay. And the short option contract wants time decay to happen and wants implied volatility to come down. Now, the battle here is that they fight against each other, right? So if I look at the long call spread, and I highlight it here inside the options playbook website, we're going to buy the stock. The stock is going to be right around strike A in this instance. So I'm going to talk a little bit about why I picked that strike. Usually I like to go a little bit into money, but we're going to look a little bit as to why we might pick this strike A, a little closer to that. And then we're going to sell strike B. So we're going to buy the more expensive option contract. We're going to sell the less expensive option contract. We want the underlying stock to go up above strike B by that expiration date. And if it does, we can make the maximum. If it doesn't, we have limited and known risk to the downside. So when I'm setting up a speculative trade like this, after it's not really a major news event, but a major event, I would call what happened over the weekend, a major event as far as cryptos are concerned. And if I'm looking at this trade, how do I manage my risk using this long spread? So strike A is going to be an at the money option contract. Strike B is going to be an out of the money option contract. I want to make sure that I have a little bit more upside ability on this trade as opposed to the downside. So we're going to go 5 points wide on our trade, and we're going to pay around $2 for that trade overall. So that would give us 3 points of upside, because the maximum the spread could trade for is the width, which is 5 points wide. And the maximum that you can lose on the trade is the net debit that you paid for that trade. So let's go to the Ally Invest option chains, and let's see where Coinbase is at right now. All right, so solid move in Coinbase today. It's up about 5.5%. It is volatile, like the cryptocurrencies in general. I mean, maybe a little bit more muted overall. And if we scroll down, we're going to go at 17 days. These are the expirations that are available. We have a lot of premium in the option contract, a lot of juice, a lot of implied volatility, many different ways to say it. So since we're buying an option contract that wants the market to go up and selling one that wants it to go down, the time frame is very important. If you're correct on your forecast, you want to be correct closer to the March 4th date, because that short option contract needs to have some time decay. It needs the premium to go down if I'm correct on my forecast, because I would have to buy it back and close that position. And in order for me to make the maximum, two things can cause that. One, the implied volatility actually goes down on the option contracts after you purchase it and your forecast is correct. Two, expiration approaches, and you're once again correct on your forecast, hoping that it gets to your strike, but you get some time decay that will happen. Lastly, if you get way deep into money, if your short option contract gets deep in the money, then time premium also goes away. Time premium usually hangs right around an at the money option contract. So those are the three scenarios that could help you make the maximum on your trade. Now, on the downside, if the market does go down, well, we have limited and known risk. It's going to be limited to what we paid for that option contract. So, for example, I like to compare this to just buying an option outright. When I look at Coinbase on that March 4th expiration with 17 days remaining, the stock is at 206. We're going to buy the 207.50 strike. Now, if we bought it outright, the asking price is $15.10. So you're talking about $1,510 to buy that one option contract outright overall. So that's too much risk. And we're not even in the money. We're out of the money. I don't like that risk reward scenario there, because you're going to be battling time decay and fluctuations in implied volatility if I buy this option contract as much as the potential move of the underlying stock. So how do we do that? How do we reduce that risk and manage it? We go out and we're going to go 5 points higher, and we're going to sell the 212.50 strike. So 5 points is the width of the spread, 207.50 to 212.50 overall. 1 second. All right, 1 second. I'm going to take a water. And if I look at that trade, then the maximum that we're going to pay for it is 2.25. Now, when I started the trade, it was $2. When I looked at it, I'd like to pay $2 with $3 worth of upside, specifically because we're buying a little bit out of the money. Now, the reason why I'm going a little bit out of the money, and I might even adjust up to the 210, is the potential move or the expected move of the underlying stock. It's right around $30 by that expiration date, right? 17 days remaining. If we look at buying the at the money call and the at the money put, 16 plus 15. So we're talking maybe $31 at the midpoint. That's the potential move. So the marketplace thinks that if it's going up or going down, that this stock can really move in 17 days by that March 4th expiration. So we want to be within that expected move range. Now, there is a little bit of a skewing in the option contract. So I would like to be able to pay $2 for this trade, but right now it's trading for 2.25. I'm going to make it the official paper trade because I don't want to go down that road. But the main thing is that I want to manage my risk by doing the spread. If I just buy this option outright and pay $15.10 for it, I could say, oh, if it goes down $2, I'll get out. But that's really hard to do on a very volatile stock, especially with a little bit wider bid-ask spreads. So I would rather do a spread in this situation, a long call spread to be specific. That's the trade that we're going to look at. And then I can manage the risk and I can actually just let the trade ride overall and see where it ends up because my risk parameters are already in place. I got a little bit more upside than I do downside. I could say to myself, well, it's a 2.25. If it gets down to $1, maybe I'll get out and try to salvage that last dollar. But in general, if I'm setting up the spread this way, I'm going to pay what I'm willing to lose if my forecast is incorrect. So 2.25 is the paper trade. Now, not meant to be a recommendation. We're just trying to learn here. So we're taking strategies from the options playbook that would apply to the current conditions in the marketplace. Big news in Coinbase over the weekend. Just a lot of chatter, I should say, in social media overall. We're going to have $2.25 worth of risk. So let me put this in the right rail and make this the official paper trade for this week. And we see that we're looking to buy the March 4th expiration, 17 days away, 207.50 strike call option, and at the same time sell one of the March 4th expiration, same expiration, to 12.50 call option. Right now, the midpoint is at $2.25. No, it's $2.30. We're going to make it $2.25. It was $2 before the show kicked off, but it is what it is. The markets do move, and we always do the show live. So our maximum risk will be $225 for every 1-by-1 spread that we do, plus commissions. Our max upside is going to be $2.75, less commissions. Basically, you take the width of the spread, $5 minus the $2.25, and that gives you the maximum upside on that trade. And we'll run down and we'll look at the profit and loss graph real quick. And I see some chatter in the chat box, but if you have any questions, please put them in and I'll try to address them here after we chat a little bit about the profit and loss graph inside the Ally Invest platform. So what are we seeing right here? This is the underlying stock price is this gray line. As we go up, we see that the colored line is currently where we're at as far as options are concerned. And this is a big reason, as far as our profit and loss is concerned, why you want to be closer to expiration when you're right on your forecast. Or, like I said, you could get way deep in the money. But because there's so much volatility, the at-the-money vol I'm going to highlight is right here is 87%. This line is very flat. As expiration approaches, the colored line will morph into the dotted line. So let's go all the way down. I'm going to actually just put 0 days to expiration. That usually means 1 day worth of time premium. If we look at it now, we're starting to see that if I'm correct on my forecast, closer to that expiration date, I'm going to get rewarded more on my long call spread than if it happened right away on that trade. So, moral to the story, when you're doing long call spreads, picking the correct expiration is almost as important as picking the strikes. Now, what's the downside of doing this trade a little closer to the expiration date? Well, maybe the move happens, but you missed the move. Maybe the move takes more than 17 days for it to take place. Or maybe it moves too quickly up to the upside and comes back down. Overall, the hardest thing on setting up a long call spread is trying to figure out exactly what expiration date that you would like to buy. Now, if I'm just buying an option outright, just buying that call option, it's always easy to err on the side of buying too much time, right? Because you don't have an option contract that's working against you like we do on a long call spread, where we sold that option contract that wants the market to go down, bought an option contract that wants it to go up. So much easier to pick the expiration if you're just buying an option outright. But I wouldn't want to do that in this specific scenario, because you're paying so much premium for only 17 days worth of time that you're trading by buying an at-the-money option contract outright. You're trading fluctuations in that implied volatility, and also you're battling time decay. Each day that goes by and the market doesn't move or goes down really hurts that position much more than it does in the long spread overall. All right. Well, if I look over at the chat box, do we have any questions? Let me see what we got going on here. Okay, William just popped in, and William says, I follow along on my Ally Invest screen, AI. Why are your calculations different than mine? I'm showing 240 net debit when yours shows 225. I'm probably, well, it's 235. It's moving all over the place. William, they should be similar, but there's also a delay on my website, right? Because we're taping a video. So there's about a 5 to 10 second delay from what you're seeing and what is getting posted on YouTube overall. So just keep that in mind. And obviously the stock is really moving today. At this point in time, we see it's up 1076, up 5.5%. A lot of volume, a lot of activity in the underlying stock. So that 10-second delay is kind of a big deal. All right, Wayne. Hey, Brian, can you show how you would defend this by turning it into a butterfly? Okay, so if the market went against me, Wayne's talked about an adjustment that I've made from time to time in the stock play of the day overtime, which we do every Friday. And the adjustment would be that if the market went against you, you could turn this into a butterfly. So you go from, and I'm going to highlight it inside the options playbook. This is one part of a butterfly. This is a long call spread. If you go and look at if you sell a short call spread against it, which is this, so that's the short call spread. Here's the long call spread. Note that we're going to come together right in the middle, and that's going to form a butterfly. So let me run on out and pull up the butterfly, long butterfly. There it is with calls. So this would be the long spread, and it would continue on up, dot, 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 dot. That would be a long spread. This would be a short spread, dot, dot, dot. And that would, but you combine them both, and guess what you get? You get a long butterfly spread. So it's a little bit of an advanced concept. But if the market did go against me, and let's say it went 10% to the downside tomorrow, it's up 10% today, went 10% to the downside. What you could do is sell a short spread against that position. And this is something that we would, if the market did do that, we would talk about it on Friday, but you would go out another 5 points and you would look to buy this option contract right here. And that would be the 217.50. And when you did that, you would also sell another one of the 212.50s, and that would remove some of the risk, but still keep your toe in the water. You'd still be in the game. You'd still have some bounce back. So I would only do that if the market had gone against me and I decided that I don't want the cheese anymore. I just want out of the trap. It's always a little phrase I like to use when I'm hedging a position. You're not adding on any more risk to the trade. So in general, it doesn't bring in any more, it doesn't take any more capital to roll into a butterfly. Because if you look at a long call butterfly, right, you have limited and known risk on each side. So just like if you did the long call spread outright. So by rolling into it, you bring in a credit, you reduce your risk a little bit. You do not add any margin. You do not need any more capital to put the trade on. But if you do that, then at expiration, it's even, you're selling another option contract. So let me put this in. So the profit and loss graph is even going to be more flatter as far, well, we're going to go all the way back. Let's graph these three. As expiration approaches in this range, it's going to be even harder to make that maximum if it does go back towards your strike, because you've sold 2 option contracts now and bought 1. So you need both of these option contracts to decay if you're correct on your forecast in order to make that maximum on the trade. But it does give you an option of getting out. If I sell that short spread, bring in, let's say, $1 or so, I reduce my risk overall. And if it lands somewhere within these strike prices at that expiration date, you got to chip in a chair, if you will, to use that phrase, just in general. All right. Clinton asks, I was convinced that one individual stock was going to decline, but wanted to protect against the entire market. S&P went up, rising tide. How would I do that? Okay. I'm going to try reading this one more time and then try. Clinton's asking if I was convinced that an individual stock was going to decline, but wanted to protect against the entire market, I guess, going down. How would I do that? Well, one of the biggest things in this, in Clinton, you're mentioning the S&P 500 index, but I'm not quite grasping exactly what the question is. If I'm worried about an individual stock going down, obviously the first thing you can do is sell it. Second thing you could do is buy a protected put on that one individual stock. If you have a portfolio of stocks that looks a little bit like the S&P 500 index, an easier way to try to protect your portfolio is to actually buy S&P 500 index options or SPY options that trade on the ETF that tracks the S&P 500 index, and try to buy a couple of those to try to protect your portfolio. If you want to protect an individual stock, though, you have to buy a put on that stock, just in general. But don't mind that if that stock happened to be in the S&P 500 index, that you just bought maybe an SPY put as opposed to buying a put on that individual stock. Now, this is getting down the rabbit hole. You'd really have to look at your portfolio and talk a little bit more about that. But inside the options playbook, and I'll highlight that right now, the strategy is actually called a protective put. And you can do that on the stock, and you can also just you can buy a put outright at any point in time. So you could just buy it in the S&P 500 index if you wanted to, as an alternative. How can I roll options on Ally? Can't find the option for it. All right, Andrew. You would have to go to the holdings page, and you should be able to, you'll see a ... on the holding. Click on that, and it should allow you to roll your option. If you have a question, you can call the trade desk. They can work you through it, but it's on the right-hand side of your holdings page. I have a test account. There's no option trading in it right now that we're using today. So you'd have to go on the right-hand side, click ... and then it should give you an option to be able to roll that option contract. Another way is just quite simply, you go to the option chains and say you wanted to roll just an individual option. You would actually just set it up as a spread, right? So if we were rolling this and you had these 2 option contracts in, let's go back and kind of show you it. Let's say that we were long this option and we wanted to roll it out in time. So we would sell to close that option contract, and then we would buy to open a different option contract. And we'll go out, let's just to make it a roll out in time, we'll go out to the March 11th. So that would be a roll up and out. So we're selling to close the long option, buying to open a new long option. And that's how I could just set it up right from the option chains overall. That's a simple way to do it, but you should also be able to do it from your holding screen. Okay. Buy a put on an individual stock and buy a call on the market index. Yeah, Clinton, you could do that. You could buy a put on an individual stock to protect it against the downside and buy a long call in the SPY. But now, not quite, I mean, without looking at your portfolio and everything that you're considering, is that a viable trade? Yeah, without a doubt. But I don't know exactly how I would set it up. It would be, buying a call option on an index like the SPX or the SPY, an ETF, is an alternative to actually trying to manage risk. And we've talked about that recently in the stock play of the day, but on sector ETFs. We looked at one in MRO, which was mainly a play on energy. And then we also looked at one going way back in time on the XLF, which is the financial industry, and buying a little bit in the money option contract. We built it as a FOMO trade, fear of missing out. If you thought interest rates were going to go up and you wanted to play in the sector that usually will benefit the most from a rise in interest rates, which is the financials, the banks, et cetera, this was one way to do it. So you'd have to go back in time and look at the XLF, which is an ETF that tracks the financial industry overall. Bought a deep in the money option contract to participate, manage the risk of that underlying stock, and bought something that acts like the stock, but basically isn't the stock. And that's a deep in the money call option. So that's a strategy, and that would be homework for you to go and check out overall. All right. You're welcome. All right. That's going to be it. We ran a little bit over. We started a little bit late. Apologize for that. Please check out Lindsay's article, and we'll put that in the chat box one last time. Very interesting article this week that goes out to all Ally Invest account holders via the email, but you can check it out by going to the website directly. And I'm also going to grab a couple of things because I also set up a couple of quick links that I haven't really shared with a lot of people. If you'd like to know about all my educational events, you can actually sign up for them directly by going to this link that's in the chat box right now, ally.com/invest education. And will put you on an email list that we will alert you when we have big educational events, sometimes weekly, sometimes we do digital conferences. We won't over spam you. We'll only send out one email a week overall that will highlight some of the things that we're doing at Ally Invest. And as always, you can click subscribe right here on the Ally YouTube channel and ring the bell, and you'll receive alerts for all the stock plays of the day and everything that we do via this channel. So please do that. And thanks for coming, everyone. And we'll see you this Friday for the stock play of the day overtime.